Welcome back, everyone. I am Cass Piancey, and I'm joined, as usual, by my partner in crime, Mr. Bennett Tomlin. Wow, I screwed that up. But we have a special guest today, and to be honest, I'm just going to defer to Bennett so that he can introduce our guest.
Today we are joined by owner of the Dallas Mavericks and the favorite shark for our producer from his favorite TV show, Shark Tank, Mark Cuban. How are you doing, Mark?
I'm great, Bennett. How are you?
I'm doing quite well. So I think to start, both Cass and I are actually huge fans, and one of the things we bonded over was actually a movie you produced called The China Hustle.
Yeah.
And I mentioned this once on Twitter, and then you pointed out to me that you had also ran another website called Share Sleuths that does investigations into a bunch of different companies possibly committing frauds. Yeah. So can you talk to us a little bit about how you got interested in those types of frauds and how you think about shorting?
So let's start with Share Sleuth. For every 100 or 1,500, whatever the number is, good companies, there's always going to be a scam. Always. Why did Wee Willie Keeler? No, that's not who it was. Why do people rob banks? That's where the money is. Why do people have scam companies that go public? That's where the money is. And so there just wasn't anybody who I thought was doing a good job, one. And two, was an opportunity for me to make money. Most investors just don't do the work when it comes to investing questionable companies. There was one of the companies we did originally, and I'm spacing the exact name of it, but effectively they were a company that was coming up with some new energy, whatever. And they had this big plan and that they announced, and the stock would go up. Then they do another press release and the stock would go up. This is around the 2006, 2007 timeframe. And so what Chris, who does all this work for me, did was he called somebody locally and said, go look at the plant, see if their lights are on. There were no cars in the parking lot in the middle of a Monday afternoon or whatever. There were no lights on. He called the utility company to check to see if there were any utilities turned on. No. So he wrote about it. I shorted the stock, and we've been doing that for the last 15, 16 years. And, shorting, there's a bunch of different reasons to short a stock. One is you think about valuation. I usually don't short based off of valuation, or I haven't in years and years and years, because you don't know what the market's going to do. But then there are companies that are just outright scams, or they're run by people that have bounced from scam to scam to scam, or they're run by people who are really good at pumping up stocks and allowing somebody else to dump those stocks. And Chris has done an amazing job of defining those networks, and that gives him a big advantage. And I disclose when I have whatever position I have, if any, in the stock. Some, there's just not enough money there to make it worthwhile, but we'll publish in any ways to try to protect investors. So that's why we did it.
My question is, like you said, you've been doing that for 15 or 16 years now. So I guess I'm wondering, it must have proven repeatedly to have been profitable for you to continue to do it, right?
Yep.
Okay. Okay. Yeah. I'm wondering if you think about Share Sleuth, like if these tips and tricks and all of this stuff, if you think about it similarly to the China Hustle, where like you could build stories about it the same way that you did about the China Hustle, or is that just such?
No, not at all. Totally different. No connection at all, actually. I did China Hustle more to embarrass the SEC because there are all these reverse mergers that you couldn't even audit their books.
Right.
So and I would give the SEC shit for years now. And it's the most obvious hustle ever that they're just now starting to address, and they still haven't fully addressed it. You can be a public company and your books not be audited, and there's no way for investors to even find out what your actual P&L or balance sheet is.
And
that's the definition of fucked up, And I remember probably 5 or 6 years ago, right before we did China Hustle, talking to Jim Cramer on CNBC, and I said, at the time, there was like 4 trillion out of 15 trillion in market cap were Chinese-related companies, Alibaba, etc. And I'm like, Jim, there's no audited financials that anybody can trust. And, the government of China could just say and tell them, to do whatever they want them to do. And, why are we allowing these stocks to be traded on our big exchanges at all? China didn't like it. The SEC didn't like it, but it was a fact. But I did do it I did it really just to embarrass the SEC because I was fighting them at the time. And it was just ridiculous, the hypocrisy and the irony of it all. And to this day, now at least they're starting to try to address it. But the concept that you can be a multi-billion, hundreds of billions, whatever it may be, valuation stock on a major exchange in this country, and you can't really test or trust the financials, that's the definition of insanity.
Sorry, do you see any similarities between those Chinese reverse mergers and some of the multi-billion-dollar SPAC deals we've seen in the last year or two go public?
No, they're different. And I got offered to do a lot of SPACs and just refused to do it for a lot of reasons. There's a difference between the VIG that a SPAC allows the creators and the initial investors to gain versus having zero transparency. It may not be great economics for investors with a SPAC, but at the same time, it's transparent. And as long as you have the transparency, I think that's what you need.
Can't SPACs go public without audited financials, though, in the same way that a reverse merger can?
Well, the SPAC itself can, but you've got to merge in the company, and then at that point, you've got to get audited.
Yeah, for your initial year's filings, but you're still trading
So yes, you can have a SPAC that promises anything and everything, but that's the ultimate speculation because there's no company for you to examine at that point in time, and you're trusting the people putting together the SPAC. So that's just like hiring an advisor and you're giving them money and saying, okay, go invest. That's a lot. VC funds, same type of thing, right? You don't know until you know.
Well, this is a good point I'd like to make about this now that you've brought this up, is that I'm wondering, you're saying, well, at least the SEC is starting to do some of this stuff now. Do you just mean in regard to China? Because I think
China.
Okay, because Bennett and I feel very frustrated with the way the SEC operates. I think it's a lot of hypocrisy, like you're talking about, where if you have big pockets and you can pay.
We just simplify all of it, right? There are companies that trade on exchanges, major exchanges. And we can argue, and the SEC will argue what they do or don't do, and whether it is what value there is. Then there's the bulletin board, pink sheets, and OTC stocks that all get traded where anything goes. And that's always the analogy I use for crypto, right? Because it's like, you think stocks are safe? I don't even know the number of publicly traded stocks now because so many went public. Let's just say it's 6,000, right? I'm betting there are far more pink sheets, OTC bulletin board stocks that trade. And it's ridiculous that there is no oversight other than basic reporting requirements at best. Now, it's harder to find pricing and everything, but that's all the more reason when there's horrible price discovery, there's more opportunity for fraud. You see bankrupt companies trade, and they trade millions and billions of shares. It's insane. I've said this for years since I started battling the SEC. If the SEC truly wanted to protect investors, they'd go through a process of making everything they do bright line. There are no bright line regulations. The SEC is made up of mostly attorneys because that's how they want to approach things. They want to litigate to regulate. And to me, that's just wrong on 1,000 levels. And then, furthering the hypocrisy, the SEC talks about wanting to protect our markets. Well, if you look at things like insider trading, as it applies to other countries, right, and other markets where they don't have an SEC equivalent, or it operates, with 1/10 of the intent of the SEC. Yet there are funds for those countries that trade on the major exchanges. Developed marketing funds. So pick a country that has a developing stock market, and there's an ETF or something for it. And so the SEC approves an ETF to invest in companies that have no audit standards whatsoever and no oversight, and allows any Tom, Dick, or Harry investor to invest in that. It's insane. It is absolutely insane. The job of the SEC doesn't look at their job to proactively protect investors. They're completely reactive.
Yeah, that was That was a point we talked about with Jim Chanos when he came on our show last week, where he was talking about how short sellers are really the only ones with an active incentive to go out and try to identify frauds because they can make money from it, and that the regulators really only come in afterwards and document what the fraud was.
Yeah, and there's whistleblower things with the SEC, and ShareSlip, we've applied many times for whistleblower reimbursements because we found many things. And they're like, well, no, you put it online first. You got to tell us all these different excuses, right? And it's just, obviously they don't want to write a check to me, and so I get that and I'm fine with it. But yeah, the hypocrisy runs deep in the SEC.
Well, this transitions us to, I think, to our next topic, which you were famously invested in Iron and Titan, which was an algorithmic stablecoin that collapsed. We recently had another collapse of a major algorithmic stablecoin, UST, Terra Luna system. I'm wondering how you feel about the future of algorithmic stablecoins and whether or not you think they're worth investing in now.
Okay, so there's two parts to that question. One, I didn't get hit nearly as bad as people thought I did on Titan, and I made a lot of the money back being an LP. But it was still, however it played out, depending on who you talk to. What it taught me was, marketing matters in crypto, and when you add the word stable to anything, particularly stable coin, it's a misnomer when it's applied to algorithmic stable coins. So I said at that point in time, having been burned and learned, that's a new crypto. They burned and learned. I'm gonna trademark that. Burned and learned. But having been burned and learned, it became, you start digging in more, right? It's just like when a stock collapses and you realize why it collapsed and you try to not repeat that mistake. It became obvious that you can define or create algorithms that have any different type of output. But when you call it stable, particularly within the crypto market, then people associate it with stability. And that's what has to change. You can call something an algorithmic token and have it be a function of any number of other inputs. Great. Have at it, right? Because there are other tokens that are some percentage of the LP fees, and in some respects, that's an algorithmic token in and of itself, right? And so you can algorithmic away, just don't call it stable. And for stable coins, it should have a peg where it's auditable, definable, and trackable. And I'm fine with the concept of stable coins, but there's and it's not that you couldn't have an algorithmic stable coin that's pegged to the dollar and invest in treasuries, and you get an additional 0.01% of the treasury returns, interest rates, right? And that in and of itself might be algorithmic, and maybe they invest that 10% of the interest rate they earned in Luna, right? And you get those Luna tokens, and that makes it algorithmic. It's the point that you have to have it stable. If you're going to use the word stable, there has to be a definable, audible, traceable peg. And that just is not the case with all the algorithmic coins that are out there now.
When you've talked about the appropriate regulations for crypto before, you've suggested that you think stablecoins are likely to be the first thing to be regulated because they represent this huge pool of effectively US dollars.
Well, it's not the fact that what they represent. It's just a misnomer. That's it. If you called quarters dollars, people are going to be misled.
Yeah.
I guess now that you say that, I'm reflecting on how we have money market funds, and while they might be set to $1 for each, share or whatever, it's called a money market fund. It's not called a US dollar derivative or something. They don't call it what it isn't.
There's been funds that have been pegged to the dollar that broke the dollar, and people have been, I don't know if anybody went to jail or not, but it wouldn't surprise me if somebody did. In 2008, a lot of that happened. There's been other times when it happened. So it's not unique to crypto, but how you name something in this day and age matters. And you just can't call it stable. That's the whole thing. You create an algorithmic coin, and call it algo coin and do whatever you want with it. It could be Titan the exact same way. It could be Terra and Luna relationship the exact same way. Boom. Then you just, you plays the game, you take your chances.
So, like in that vein, what I was trying to get at is you suggested that the asset-backed stablecoins, the Circle, the Tether, the whatever, they should be auditable, have their assets in a place where professionals can make sure they're there so that people know the dollar's worth a dollar. In the case of something like an algorithmic stablecoin, you're suggesting that basically those shouldn't be marketed as stablecoins.
Yeah.
What is how do you think about the regulatory framework that makes it so people can't call Terra?
You pass a law saying that if you suggest that you are pegged to something and you try to reflect on a day-to-day basis a particular amount of some other type of asset, you have to be trackable, traceable, auditable.
Okay. And so then just go after criminally or civilly those who are violating that and
plus the market, the crypto industry is evolving enough and maturing enough that it would self-regulate, but only after the feds went after 1, 2, 5 people, whatever it may be.
Well, when you say it would self-regulate, does that just mean like short sellers, share sleuth, like Jim Chanos?
With social media now, there'd be enough of a groundswell of people who would call people out that are misleading investors, because there is enough self-interest in this industry. There's always scammers, and any place where there's money, there's scammers, right? But there are enough people who want to see it succeed that they're gonna help educate people, and I think that's happening more and more as more people get burned and learn. I like that more and more now. But you get my point, right? When I say self-regulate, I'm not saying don't have any government intervention or regulation at all. But what I'm saying is, it's like insider trading. There is no real law on insider trading, but companies do training on what you should not do. And people generally who trade stocks in any volume understand generally what they can't do.
Mark, can you discuss what you think what would be useful bright lines that could be passed that would help make crypto safer for the average investor who's interested in it?
You can't right now, other than the stablecoin stuff. It's really, really difficult because of social media. It's not like it was 20 years ago, even where even if you were trading online, you went through some sort of trading company or broker or banker that had rules in place. And so, it's really difficult because anybody can create a token. And whether you want to define that token as an equity that needs to be registered or not, depending on what it does, it's going to be really, really tough right now. But it's no different than, an entrepreneur who comes on Shark Tank and has sold 100 shares of stock to all their friends and family, and then I destroy them because the company's a joke.
Yeah.
Any entrepreneur can create any company that they want and sell shares locally to friends and family, just like any token entrepreneur can do the same thing.
Okay. Do you think something like you mentioned in a thread back in September of last year, having some kind of proof of authorship and identity for specific smart contracts and tokens where people are aware if there's changes to the tokenomics or the code or things like that? And that seemed to overlap pretty meaningfully with the token registration proposal that Sam Bankman-Fried proposed recently, where to get listed on these exchanges, you would need to have a lot of that type of information. So is that kind of what you think of as a starting place?
What I also said was it was analogous again to the stock market, right? Where there's going to be different tiers and different confidence levels. And so if you register, then you're going to be on the NASDAQ or the New York Stock Exchange, whatever it may be, and that will give a different level of confidence. If you choose not to, and you're just a private startup like everybody and their brother creating their own company, then that's your choice as well. But you're not, if my 12-year-old son Jake creates a company and sells shares of stock, and somebody tries to sell those shares to somebody in New York, right? There's no reason for them to have confidence in anything that person trying to remarket those shares says. But if, the equivalent would be for a token, right? So what's a recent token that came up? that's relatively, I don't know, pick any one that now has, a multi-billion-dollar market cap. If you want to have some confidence in that it's real, register it, make it auditable, have, pay $10,000 or $20,000 in cash, not tokens, so that there's a third party that works for this exchange that goes and does an in-depth audit, so that there's some level of confidence.
Aren't there already auditors, or at least security, like security auditors and stuff that are looking over these coins and certifying them with their like security passing audits? And I think one is called like Certicay or something like that. But
Yep, and then there's others, but the point is we don't know which ones are the good ones.
And I was going to say that they often do these audits and then they say like, yeah, this thing is passed and it's fine. And then the coin utterly fails. And so it becomes a matter of like,
there's New York Stock Exchange, there's NASDAQ, and then there's everything else.
Right.
Right. If you pay the listing fee and you pay the amount of money to get on the NASDAQ, it may not have 100% certainty that it's not a scam, but at least when it goes public or lists, there's some level of confidence because of the amount of money that had to be paid to get that listing.
So you're seeing likely in the future kind of a splitting of the crypto market, where the ones who have gone through this registration process, who have identified teams and have gone through these security audits, are going to be listed on the top tier exchanges. There's going to be other tokens listed on offshore exchanges and exchanges that are difficult to regulate. And then the remainder.
Right. The problem, though, is there's no exchange like that exists. Right. FTX wants to be it. Binance wants to be it. Coinbase could have been it, and they fucked it up. Right. So, there's a lot of ways that it could have happened, but there's no direct path of least resistance right now. Somebody, the top 20 market cap tokens should get together and set a very high standard so that, they take on, and they all kick in and buy some insurance, right? So there's no rug pull. If there's a rug pull, everybody gets reimbursed or whatever. It's going to add significant expense, but that's just the price of poker if we want to really get this to the next level.
And like you made the analogy before, you end up kind of with like Pancake Swap, Uniswap. The DEXs is kind of the pink sheets in the over-the-counter trades, and then the more regulated where the feds can exert more influence on the NASDAQ or NASDAQ equivalent.
Well, and it doesn't have to be the feds. I mean, Sam and CZ and all those guys, whatever you think of them, they should be creating their own New York Stock Exchange where it's expensive to get on. It's completely transparent. You eat your own dog food. Everything is on a blockchain. They hopefully use Ethereum or something that everybody, can, since they're all Ethereum based, well, that they aren't all, but since, they all can have one central point of audit and make it expensive. Don't make it cheap. Make it $100,000 plus a year or $1 million to sign up in cash, $100,000 plus a year to pay for all the audits so that there's some level of confidence. Because the problem with crypto right now even though, FTX has gone down and Binance has had fraud, it's like anything else. You're a platform and there's going to be fraud on the platform and there's going to be, vulnerabilities that are exposed. That just happens. Just like I I remember back in the day, there was one company, MediaVision, where I got crushed because it turns out they were shipping product that was bricks and boxes. Crypto isn't unique to scams. It's not. It's just that it's so much more in our face because of social media.
In the same vein, you're talking about, regulation coming and separating cryptocurrencies, I think, and cryptocurrency exchanges perhaps. But what about the NFT space? Do you think, I know you're a big proponent of NFTs. Do you think that is going to go in a similar direction? I mean, we have so many hacks. We have so many lost, Bored Apes or, crypto punks, you name it, right? Do you see a similar kind of thing happening or what do you think?
That's a big deal people are making out. Look, big companies are getting hit by ransomware and getting fucked. Right? And that's just based on phishing. That's it. Somebody in the accounts payable department clicked on the wrong email link, and that opened up the door for somebody to insert ransomware, and this hospital or that hospital is shit out of luck. Companies are getting sent invoices that aren't real, and they get paid because somebody in accounts payable didn't really know what they were looking at. Phishing opens up doors to scams, whether you're NFTs, whether you're the payable department, whether it's an open door for ransomware. So that's not unique. The bigger issue with NFTs is we're going through, Warren Buffett has this great saying, first there's the innovators, then there's the imitators, then there's the idiots, right? We're evolving from the imitator phase where every blockchain or level 2 has got to have an NFT platform, right? And in order to drive volume and activity to that platform, they create all these different types of incentives and bring people in. And that's created a distortion in the NFT world where you've got basically the same businesses being operated, not just on Ethereum or Polygon, but on Binance, on all of them, right? And at lazy.com, and you can check out my NFTs at lazy.com/mcuban, we present NFTs on a lot of different platforms. But NFTs are just collectibles in the way we're talking about them right now. And whether, they're a good investment, it's just like art. But at this, or trading cards, the beauty's in the eye of the beholder with maybe a scarcity factor attached. But right now, what's really making it confusing and difficult for people who are just trying to understand it in particular, and even people who have been in it a while and have tried to make money, is everything is being replicated. It's being imitated from chain to chain to chain to chain. And you're having chains imitating other chains just to create chains, right? And we've evolved out of the TPS thing. We've evolved out of the cost thing now that Ethereum is really quieted down in terms of transaction fees. And it comes down to, okay, why am I buying this NFT on this particular chain? And the chains know, and here's the underpinning of the problem. The chains know that there is not room for 100 different blockchains. There is not room for 50 different blockchains. There is not room for 20 different horizontal blockchains. Now, if you want to look at vertical applications that are specific to, maybe ICP and others that have specific ways of doing things, that have applications that are better suited for those chains, okay, maybe the total number will grow. But because they know that this is a war for survival, they're trying to replicate what's being done where they're seeing activities and volume and creating incentives. So, all of them create rooms, places to mint and sell and marketplaces for NFTs. And there's just too many. And there's just no way they're all going to succeed.
Well, so here's a good follow-up question for that, because you're talking about how NFTs are almost exclusively for collectible kind of,
Right.
nifty
Yeah, right.
purposes like that, right? And I think Bennett and I more or less understand that. I think we might not love it, but it doesn't seem like something that is unreasonable to me. Meanwhile, though, I've heard you also say to look for utility in the NFT space. And so
Right.
I'm trying to manage to combine those two concepts, because if it's
Really
almost
easy,
okay.
It's really, really easy, right? Like if there's a Picasso, there's not that Picasso. You're not only conveyed that Picasso if you buy it out of one particular gallery, and if you get the almost Picasso from another gallery, and then another type, another piece of art from another gallery, which with each gallery representing a different blockchain, right? And so it has to be tied to that. There's a limiting factor in the collectibles market that all these NFTs are tied to a particular chain. And that creates a lot of confusion. And people are trying to bridge them, which to me is the worst thing possible because it's no longer non-fungible, right? Because if you bridge, you lock it into one bridge, host it on the second bridge. But if there's any transactions on the second, third, fourth, fifth, or sixth bridge that it's been connected to, you lose all that transaction history. Or it's just such a pain in the ass to browse through it, you lose a lot of the value of that. And you still haven't addressed the issue of royalties for the original creator. All that aside, when it comes to utility, NFTs are just an application for collectibles using smart contracts. And in terms of what other utilities that you can create using smart contracts with NFTs, with the Mavericks, we created NFTs that what happens is if you came to a Mavs game this past season and you were there before the end of the first quarter and you scanned in with your Ticketmaster ticket, right, digital ticket, then we sent to your Ticketmaster account where we created a Polygon wallet, we sent to you an NFT for that game. Now that NFT is free with your ticket as long as you show up, right? So we're rewarding people who go to the games with the NFT. By having that NFT, you now qualify for a lot of different opportunities with the Mavericks. And so like somebody who came to all 41 regular season home games, we just sent them a special signed jersey that we created. They didn't know they were getting that, but that was one way for us to create some utility for it. There'll be games.
So a rewards program.
Yeah, it's a rewards program. So, and that's a utility, the rewards program. So they'll be able to get, our preseason games, we don't sell as many tickets for, and we have empty seats. The people that have the most NFTs because they attended the most games or purchased them from other people who did, they'll be able to get free tickets or reduced cost tickets. So that's one basic application. We can evolve from there to actually use the NFTs as the tickets, which in turn impacts the resale, which allows, because it's an NFT on a smart contract, allows us to earn a royalty or a commission every time it's resold, which we can't get right now when a traditional, even digital ticket is resold on outside of Ticketmaster. So that's.
I was worried this is where you were going to go.
Wait, I'll give you
Cass
more.
and I were,
But wait, there's
well,
more.
no, sorry. Just Cass and I were smiling because we were prepping for this interview yesterday, and Cass made me try to come up with the best justification for NFT tickets, and my answer was right now Ticketmaster, the other companies take all the secondary sales, and so if you set it up with a royalty that goes back to the original issuer, they can get all those secondary sales instead of them going to Ticketmaster. So it was that's why we were laughing when you said that.
And we also were discussing that Ticketmaster is essentially monopolistic in its behavior, and that in and of itself is kind of a broken system. And so I think,
Well, you got Access.
If you're-
you've got AG that owns Access, which is a competitor. But I get your point. But wait, there's more, right? Tickets was one example. I think textbooks, college textbooks, are going to be enormous. So imagine.
why?
So you take a digital. Well, let's look at the way textbooks are done now, right? Remember when you were in college, you had to buy a book that was ungodly expensive and made no sense. And then you had to make the decision, do you want to buy new or used? You get through the semester and you realize, fuck, I wrote it in, I have my doodles, I'm going to try to sell this shit. So now you got to either go back to the bookstore on campus and get 20 cents on the dollar or 50 cents on the dollar and go and schlep around all that shit and just say what a ripoff, right? Nobody ever dealt with textbooks and didn't say what a ripoff. Now back to what Bennett said about the original issuer with tickets. What about the original author and publisher of that textbook? Every time that textbook is resold, you know how much they earn? 0. So now do this. So take an NFT, include in it a reader that, how you can export a file from an NFT. You can unlock something in an NFT. So with your NFT, you go to textbooks.com. I'm just grabbing that name out of nowhere. And you get your Sociology 101 textbook. And it cost you $60 instead of $300. Doesn't matter if you were the first, second, third, 50th, 100th user of that, and the publisher and author get their 30% or whatever, 50%, whatever it is relative to textbooks.com. And you just set with it in that NFT a digital reader that has the text of the textbook and looks for the NFT to make sure you actually own the NFT and you just didn't extract it. So it's custom. The reader is the only thing that can read that file, and it checks for the NFT. You go through. If you want to print it out, you can. Fine. Waste all the paper. That's up. Kill trees. That's up to you. But if you want to, then you get to your class, and then you resell it. Cash resells it. Bennett buys it. The 50% royalty goes to the author and the publisher. We're already looking to try to license textbooks in the college to be able to do this. So that is a far, far, far better application than the way it's done now.
Well, I have two questions about that. So one, I assume that most colleges, by now I would hope, are trying to move away from actual physical textbooks. Maybe I'm wrong, but
No, you're
okay.
wrong.
Okay. I would hope
You're
that
wrong.
they would be making that movement at some point when they're forced to. And I want to
No one
suggest.
because they know if Cash transfers the file to Bennett, nobody makes any money.
Well, can't they? So, like, can't the way Amazon has done Kindle, like, can't they lock this up in some sort of way that you cannot just pass this off? Isn't there a way outside of NFTs? Plus, my second question about this would be NFTs would, like you're saying, promote this idea of the author getting the resale value or like getting some sort of royalty on the resale of this. But the open market, we're talking about the open market here. And so I assume actually that the prices for these NFTs would spike every time the semester is starting and then plummet shortly thereafter or something. Like,
That's fine because you're still getting your royalty. Because I talked to a publisher, the lifetime of a book typically is 5 years. And so they price it knowing that it's going to last 5 years in any given college for any given class. So that's why it's so expensive, because it's expensive to print them, it's expensive to ship them, it's expensive to deal with them, it's expensive to, if there's an update to kill the books that are no longer valid, right? All those things have a specific expense. And in terms of why not just do it without crypto and just do it with Amazon, they're terrified of Amazon. They don't see, you talk about centralized versus decentralized, right? They see Amazon as a threat, not an opportunity. And so by doing it on crypto, where you just have a standard NFT, you have a standard reader that is safe enough to protect the text, or they can create their own for that matter. They can use your own custom. It doesn't have to be someone else's. It just has to be extractable so that it can be used with the text. Now all of a sudden, you can buy and sell any numbers, and it's cheaper. It's a whole lot cheaper because you don't have to, the revenue doesn't have to cover 5 years. It just has to cover 2 years, right? The original sale, and because you're getting 50%, maybe 3. But the profit margins on that, because there's no physical book like that, are enormous. The marginal cost to deliver one more book is de minimis. And so there's 1,000 reasons why using NFTs for textbooks in college and after, are better. And it's the same for a lot of professional books. You're taking the LSATs, yada, yada, yada. So that's the second application where the utility is far greater when you're in a decentralized manner. And it's more efficient because if you're using standardized smart contracts, it's going to be really, really easy to resell without going to any, of 3, 4, 5 different used book resellers. Or back to your college. I got more.
No, that one was just it makes sense to me, and it has a natural feedback mechanism that kind of drives down the cost of textbooks in general, because if they're getting 100% of the initial sale and say 50% of all secondary sales, they're incentivized to continue to issue more of the tokens, more of the textbooks, until the initial sale price starts to approach the used price, so that they're capturing 100% of that basically instead of 50% of the lesser amount.
Yeah, so you can resell it. It's easier to resell. Students are happier. There's more cycling of money at the school, because that money that's sunk into a $300 textbook that should be $60, that's $240 that could be spent elsewhere, or $60 if they bought the used textbook for $120. There's just so many downstream benefits. Another example is I invested in an application called dClimate, and it's part of D'Arbor. I forget the exact name. You can go on markcuban.com, and I got all this shit listed that I've invested in. And so let's just say I want to buy weather insurance for the Mavericks, because in Dallas, people won't drive in the snow. And so let's just say for the cold months in the Mavericks schedule, I want protection for up to $1 million for any given game where the temperature is under 25 degrees and the precipitation is over 2 inches, meaning we have 2 inches of snow, which for us means 20% or more of potential game attendees are not going to show up. Now it's almost impossible to write that efficiently and quickly. And you talk about centralization, like any insurance product. Centralization means you've got to get a salesperson, get it approved, yada, yada, yada. We're working so that you set up an Oracle where here are the different options for, here are the different dates. Here, if you put in this, it's almost like when you use options on stocks or crypto, right? For this expiration day, here's at the money what it costs. Here's at this premium, that premium, this premium. Here, this is what you get paid when these different things happen, right? These different triggers happen. It's just now you go to one platform, you connect your wallet, you buy your insurance, or you will be able to do this, and it's simple. You don't.
Why aren't you able to do that now, if you don't mind my asking?
No, you can. It's just a pain in the ass and a lot more expensive.
Why? Why is it more expensive now to do this than it?
Well, I have to find an insurer who's willing to do it, and then they've got to get three people to approve it. It's not that you can't do it. It's just, crypto and it's like DeFi. It's not like you can't borrow money or you can't just use your credit card. It's just faster, quicker, simpler sometimes. Just, if you have $1,000 in USDC to borrow $500 at, a variable interest rate that's probably going to hover around 2.5% and just pay it back when you need to without getting hit with all the incremental charges. It's not that you can't do it elsewhere. It's just it's easier and quicker.
So, like for the example you gave there, like buying weather insurance for the Mavericks, is the insurance product itself like a DeFi product that's using climate as the source of truth, or is it like a regular insurance company who's using that as like the source of truth?
Well, insurance is just pulling of capital, right? And just risk management at that point in time. So it's algorithmic, if you will, where they're saying here's, based off of 200 years of weather history, here's what we think in, the American Airlines Center, the weather is most likely to be on January 7th, the day of the game. And here's the likelihood that the temperature will be under 25 degrees and 2 inches of precipitation. Very, very slight, but they know how to, the word that insurance they know how to do the math, right? They can figure it all out and assign the risk and charge a premium and just make that an algorithm that pops up that makes it easier to buy.
And so I guess my struggle is, so like then for something like this where you're buying the weather insurance on chain through this protocol, as soon as the oracles post that the weather data hit whatever conditions were specified, then it automatically transfers the funds that were previously escrowed over. Okay.
And you can see the simplification there. Oh shit, the weather in Dallas is bad this week. I want to cover myself. And their algorithms are, I'm spacing the word that insurance company use. Anyways, but it's there, right? And look, there's a simplification that comes with wallet attached transactions. We never really discussed the fact that going to a website, connecting your wallet, and I'm not saying you take your big investment wallet. People should have multiple wallets, right? Just like, you have different credit cards with different limits just to protect yourself when you give one to your kid or cousin or friend or whatever. But the idea of just going to a website, connecting your wallet and immediately transacting and it's done, and preferably on a low gas platform, there's that simplification and speed of transaction. There's a lot to be said for that, and I think that's going to have an impact on e-commerce as well. Because right now, the big simplification is you go and you can use PayPal with your login, and maybe you're already set in your browser, or or Chrome fills in all the blanks, and we think that's super easy, and all we do is put in the CVC code. But damn, if you're not using credit and you just connect your wallet, that's faster and easier. And that's one of the things we're looking at different companies where, my e-commerce is, okay, connect your wallet. I don't have to show all the shit, maybe I want, obviously I got to get your name and address to ship you whatever. But if it's just a wallet, connect, pay, transact, yes, approve, sign it through the wallet, done. To me, that's a better way to transact.
Isn't the trade-off though that like it's more potentially catastrophic? Because like when you're paying with a credit card, you can
all your money. So if I'm going to shop for a textbook NFT, right? If you only have one wallet and that's your bank and everything, that's catastrophic. If you're going to go buy a NFT textbook, it's like how much cash do you carry with you when you go out, if any anymore, right? You're not going to carry everything you've got in your bank account. If you have half a brain at all, you're separating and segregating. So, okay, this is my shopping wallet. If I'm going shopping and I'm not going to spend more than $100, I'll just use USDC and transfer it to my shopping wallet. And when I'm done with it, I transfer it back.
But I think what the point that Bennett is trying to make right now is about reversibility. Maybe I'm wrong, but I think Bennett is touching on the idea that with your credit card or your bank, you can reverse these transactions if it goes astray versus...
You can't with cash, right?
Well, that's true.
And if I'm buying something from Bennett and Bennett fucked me, well, then I've got lots of ways to respond to that. Or if it's just an honest mistake, then Bennett's probably going to return the funds. I'm not saying go on the dark web and buy, whatever it is you shouldn't be buying. I'm saying this is, a normal transaction. So imagine it's Amazon and it's just cheaper if it just comes out of your Polygon wallet and that's it.
Don't you think that this is so much different than the original intention of like Bitcoin, for instance? Like what you're talking about doing is having these wallets that essentially, I mean, to me, it sounds like in a lot of ways could very well dox you. Like it would be used for rewards points. You'd be giving people your address, your name. You'd be logging this wallet in and connecting it to a bunch of who knows sites. Like it seems like this is very, very far from the idea of like private money.
First of all, I don't care about that shit. I care about the and there's a lot of things that at their inception, when we started AudioNet, which was the very first streaming business in 1990, early 95, we thought that our first source of revenue was going to be kind of being Muzak for e-commerce sites because that would help you buy more or you'd have a voice of God talking about the product. Nobody wanted to pay us to do that, but they wanted to hear the Cubs games and they wanted to hear this or that in the office because we were the only place that you could listen to anything, because you probably didn't have a radio or TV at your desk. And so what you initially think is going to happen in any business, I'm sure when you guys started Crypto Critics Corner, a lot of things went in a lot of different directions than what you initially expected. That's just the nature of business, and that's being an entrepreneur, and that's being opportunistic, that's being innovative. You take things in a different direction than people expected them to. Yeah, all the Bitcoin maxi shit, who cares? It's like, hey, you're an inflation hedge. Not in the United States, you're not. Maybe in Venezuela, it's a great inflation hedge, but not in a nation with a reserve currency. You're just not.
Yeah, that's one of those narratives for Bitcoin that's been around for years, and every so often I check the data to see if it's gotten any better, like when you overlay inflation against Bitcoin price, and so far it hasn't.
No,
so far it is not an inflation hedge.
But in countries where there's super inflation, right, it is a hedge, and so is the U.S. dollar, and so is any remotely stable asset. But gold, think about this. Gold's been saying it's a hedge to inflation for millennia, and it's still not. And, no commercial selling that's what they think it is, and it's not. Yeah. It goes back to stable coin versus not having the word stable. There's things that just, if people repeat it enough, they think it's true. That's why companies buy marketing, because they hope that if you say it enough, everybody's going to believe it.
Yeah. We have one last question, or at least I have one last question for you.
Not Bitcoin. We haven't talked Bitcoin yet. I wanted, crypto critics. Let's be critics.
We're doing our best, Mark. We're doing our best.
Make it simple.
Well, this question actually doesn't necessarily relate to, although I think it does in some sense, because venture capital has really started to dive deep into cryptocurrencies, I think, as of late. And we recently heard about BlockFi. I think they got devalued, right? It went from a $3 billion valuation to a $1 billion valuation.
5 to 1.
And I'm wondering if what was it?
5 to 1. They were raising it a few months ago.
Thank you. Okay, 5 to 1. Do you think there's a distortion right now in private markets via venture capital, or do you think it's just simply as murky and messed up as any other market?
Well, first of all, the question should be, is there ever a time when VCs don't distort capital markets? And the answer is no. And the more money VCs have and the more money that's out there, then the more distortion happens. I mean, look, on Shark Tank, the companies I invested, I just have to bang on them. You go for profitability, you don't go for your next raise. You've got to be profitable to survive. You can't just, I have one company I'm trying to bang on them right now. No, you can't just buy sales. Buying sales will die at some point. It's like there was a company that came on Shark Tank, Ring, and they were like, don't you feel bad that you didn't invest in Ring and Shark Tank at a $7 million valuation when they sold for $1 billion? I'm like, no, I don't feel bad at all, because they had to raise hundreds of millions of dollars to do tens of millions in revenue, and I would have been diluted until the next evolution started all over again. There was just no chance. And so it's the same now. When QE basically is UBI for rich people, and when QE is happening, quantitative easing where appreciable assets skyrocket, and particularly, it's been over an extended period of time, that money's got to go somewhere. And people tend to take on more risk and be willing to try more things. So they give their money to VCs, and VCs have to go big or go home. Because if you don't outperform, that money's going to come right out, and you're going to be embarrassed. And now we've seen what's happened with ARK, and we've seen what's happening with Tiger, where they've just gotten destroyed. But you never see Warren Buffett get destroyed like that. His portfolio may go down because he just looks at it a completely different way, and I tend to look at it more that way. And like right now, in terms of my investment philosophy, I don't want it all to go rushing back up. I know a lot of people do, and I feel horrible. People will hate me for saying that. And it's the same thing with stocks, because stocks have collapsed more than crypto has, particularly the primary crypto. There's Netflix and Amazon and you name it have gotten destroyed. Some enormous percentage of the NASDAQ, the tech stocks in the NASDAQ are down 50, 60, 70, 80%. And so, I'm of the Warren Buffett school, where you wait for blood in the street. And, I sold a bunch of stuff and, didn't try to catch a falling knife. And, if I think it goes down to below a certain point where it's crazy not to buy, like I did in 2008, like I did, other times, I'll buy, March 2020, when everything was cratering, I was buying. And so that's the way I look at it. But I do want to fuck with Bitcoin. Come on.
I mean, we've said all these things about Bitcoin before on the show, that it's not actually an inflation hedge, that the volatility has not gone down over time, that it has not gotten cheaper to use, that it's still very challenging for like a basic user to get set up with a wallet and stuff for Bitcoin. And like that Bitcoiners are not particularly passionate about making the experience easy. They kind of like that it's challenging.
Network? But what about Lightning and Strike? I'm actually more positive on Bitcoin than probably most people. There's a lot of arguments to be made about how it's not, decentralized and this and that. But, I think it's a better store of value than gold. And when people just...
That's not saying much.
No, it's not. But at the same time, people have to put their money somewhere.
Sure.
And if you look across the spectrum of assets, and whether you have $100 to invest or $100 million to invest, when you look across the spectrum, it's difficult for people just to put their money in the bank. And there's risks other than treasuries, which are paying 2.9%, where you lock up your money for 10 years.
Right.
That's not really attractive either. So people are going to make choices of where to put their money. And the question becomes what and when. And right now, I don't think it's when, but I do think Bitcoin is usurping gold as a destination, as a store of value. Because gold, people talk about, well, there's no utility on Bitcoin, and I'm can't argue a whole lot of that. There's a little bit of utility, not great. But if you look at gold, it's not like people need jewelry.
Right.
It's not like that's a need, right? That's just vanity. And so, they're equivalent in my mind. So I think Bitcoin, from a pricing perspective, I think will hold a lot better than people expect.
Here's a question. If we want to try to go a little bit more in the cryptocurrency direction, I have a question for you, because I think Bennett and I talk a lot about the scams and the frauds and the big overarching problems that we see with the industry. So stablecoins, things that present systemic risk in our eyes. And I'm wondering if you think about those kind of black swan events regularly. If this is something you think about as like when you're trying to consider risk, your risk assessment in this space.
Right. So when you look at Bitcoin, it's just the things I've said. It's a store of value. And I think it's better than gold because it's more transferable, easier. Because look, it's not like people actually hold bars of gold. Gold, the buying and selling of gold is all digital transactions. And it's all fractionalized and virtualized. So they're 6 of one, half dozen the other. And so I think there's always going to be a market for simple store of values other than cash, because people are willing to, other than your homes even, because people want to take on some risk to try to get some appreciation. Because that's the only way you're going to get wealthy. If you're just, if you're working every single day and trying to save money for retirement, it's hard at 2.9% for 10 years. And so you're going to.
Does that therefore, is that your assessment? That's your risk assessment, is like, well, I care more about the idea of like inflation, trying to find a place to put my money in the meantime, as opposed to like, well, if Tether blows up and USDC blows up and all the algorithmic stablecoins blow up and the whole market goes down 75%, that's not a top concern for you.
Well, first, if USDC is transparent like they say they are, now if there's fraud, like what Terra, that was meant to blow up the day it started, right? I got, the only thing I'm mad about with Terra is that I didn't short it. I got the opportunity to invest in Anchor, and I said no, because you can't keep on paying 20% with no source of income. But at the same time, if you think about it, think about what I just said about Ring and how people were investing hundreds of millions to do tens of millions in revenue. It's the exact same thing. Either you subsidize sales of a product, which we've seen with VCs in Silicon Valley time and time again, right? We're raising all this money, and we'll make it up in volume. That's just what's happened with crypto. People put up money and they subsidize it with rewards, and they're buying the rewards back from their customers, hoping they create enough transactions, right? And they make it up somewhere. Anchor wanted to do it through loans and they couldn't do it, right? So that was ripe for failure. USDC is not trying to do those things that I can see. I mean, are you guys seeing anything untoward about USDC?
I'm wondering why they want to go public. I'm wondering why Circle is so desperate to go public. I'm wondering
because it makes sense from their perspective. You'll get a multiple of whatever earnings you have based off the scale from the public market that you don't get from crypto.
But then the fear becomes something. I guess this was part of the question about the venture capital as well. I think the public perception, and feel free to correct this perception, please, but I think the public perception is you do a round A, you do a round B, you do a round C, D, E, whatever, and then you go public and you dump on retail. And that, I don't know if there's truth to that or not, but ultimately you look at something like Coinbase and you go, oh, wow, so that went up to like 400 and it's trading at $69 right now. Like, it seems pretty, and they did a direct listing as well, where they had to dump their shares. So I think that's the concept I'm kind of referring to, is that it feels like everybody's.
But that's the way the whole public market works, right? Unless you're the entrepreneur that created the company and just took it public. So that it's not just retail investors. There aren't enough retail investors who are buying to support the entire public market. There just aren't, right? And when they go away, markets decline. And you can see that reflected in Robinhood, right? Where you see the volume just dry up at Robinhood and the challenges that they've had. But at the same time, I don't necessarily think that's a reflection for USDC or any crypto company going public, because assuming the SEC can somewhat do their job, you've got to file all your reports, and you've got to be, have some level of transparency, and you've got to be able to demonstrate that if USDC goes public and they're not doing what they're saying they're doing, they're going to jail, right? So USDC going public is a positive for the crypto industry, and I think it returns to their investors. You're right there, but it also allows them to earn a multiple of their earnings, which you can't do as a private company, and the liquidity that comes with that. So if they want to go out and buy Tether and then all of a sudden bring it under their umbrella, where that's another however much is left until there's $62 billion, and they want to say, okay, we're going to change it so it's dollar for dollar in treasuries and USD, real US dollars, okay, there's something to be said for that too. But yeah, I don't look at going public as being a problem that, or it's a reflection of the fact that they're dumping on individual investors because they're just, companies have $1 trillion market caps now. There's just not enough buyers to retail buyers to support that. But let me just finish to answer your question. So when I look at so Bitcoin, I look as a store of value, and the maxis for the most part will just hold on because their cost, they probably already sold what they need to sell, and they don't want to pay taxes on anymore, and so they're probably going to hold on, and the data from wallets supports that, right? The longer people hold, the longer they hold, right? They do hodl. And Ethereum, the concern there, and I own a lot of Ethereum, is more on the utility, right? So what drives me in and out, and I'm waiting more on the sidelines. I've sold a bunch of my Ethereum, fortunately, is looking to see the applications that drive transaction usage. Because it was DeFi and it was NFTs, and that was driving a ton of transactions. And now that DeFi is no longer being subsidized, you're seeing 2%, 3%, and where you're seeing 10, 15, 20% or more APR, or yield rather, it's because somebody's subsidizing it in their coin, right? And they're doing it 2 orders down, where instead of just writing you a check or sending you money, they're just saying, okay, we're going to give you our token, we want you to hold it, and we'll create some inflation, and we're hoping that there's somebody there to buy it at some point in time. That's a recipe for failure. So when I see some of these chains that are just offering tokens, they better have raised a whole lot of money, otherwise they're going to fail. But on the flip side, you've got NFTs on Ethereum, and you've got other DeFi, and you've got other applications that are working that can generate transactions. So then it just becomes what new applications will generate transactions, and that's what I look for. DeFi and NFTs are no longer enough for it to just say, okay, this makes it a no-brainer. We have to see the follow-on transactions, and that's why I've said we're in a lull period, just like we were on the internet, where after e-commerce and search engines and some basic stuff, it took some time and some technology advancements for the internet really to start getting some really advanced applications where people said, okay, I have to use it. And then mobile took it to a next level, et cetera, et cetera. And that's what we need in crypto. We need those applications.
My last question, I think, is a few months ago when you were talking at Wharton's Blockchain Accelerator, you mentioned that you were recommending that your portfolio companies take a portion of the cash they raise, put it into USDC, and lend it out to start earning the yield. Is that still a recommendation you would make, or has the rising risk-free rate and collapsing DeFi yields made that less appealing?
And regulatory concerns.
Yeah, the regulatory concerns, no, but the fall in DeFi rates, yes. But there are still places where how with stocks you can loan them out and you get paid a VIG for a stock loan, right? So if I own 100 shares of something, I can go to my broker and they have a stock loan department, and the people who want to short it will borrow it, and you have to pay in order to borrow it, right? Well, the same thing happens in crypto. The exact same thing with tokens. So if I own ADA and I don't, and won't. But if somebody wants to buy it, wants to short it, they're going to have to pay to borrow it from somebody who owns it. And so the same thing happens with USDC. The same thing happens with Tether. And so I think USDC in particular is stable. So for myself personally even, and companies, it's like, okay, if you guys can integrate and do this easily in your cash management, put some of it in crypto automatically, loan it out, and if it's on Aave, it might only be 2%, but if it's through a centralized exchange, you might be able to get 6, 7, 8%. And at that point in time, it's worth it. And I've said this, and I'm trying to find somebody to do it the right way, integrating QuickBooks into a cash management system that simplifies all that, so that you sell your USDC when you need to pay your payroll, and you buy it when the revenues come in or your receivables come in, and you're making that 4, 5, 6, 8%. That can be real money depending on the size of the company, but it's also found money that you're not making right now. And to me, there's utility there as well.
Makes sense.
Cool.
Cass, you got any other questions?
No, I unfortunately I don't. So yeah, no checkmating you, Mark. Sorry.
Critics, where's the critics? I want critics.
We tried. We tried. I don't know. I think we're trying. It's better for us to ask these questions and hear honest answers from whoever we're speaking to, and let the audience decide how they feel about it. I think is kind of what we want to do.
Fine. Yeah, I mean, we'll look at the social media, and half the people think I'm a moron, and half the people think I'm close to being a moron, and maybe part of what I said is right.
No, I mean, I think you gave some really sound arguments, unfortunately. So, yeah, we appreciate you coming on so much, though, Mark. Thank you for joining us, really.
Hey, I love cynics, man. I love people who question everything. The only way people get better and industries and businesses get better is by questioning authority, right? You have to. And let me put in one quick plug. I already plugged lazy.com. If you want to highlight your NFTs, use lazy.com. But I created a company called costplusdrugs.com. And what Cost Plus Drugs does is completely disrupt the whole drug industry. So if you have any prescriptions at all for any medications, go to costplusdrugs.com. If we have it, all of our medications are priced at our cost plus 15%, plus $3 handling fee, plus $5 shipping. Period, end of story. And we're probably less expensive than your insurance copay. And if you don't have insurance, we're definitely less expensive than anything you're spending. We're approaching 1 million customers, and we've only launched in January. So go to costplusdrugs.com, look up your prescriptions, and even if we don't have them, sign up for an account, because you'll put in the prescriptions that you take, the medications you take, and when we add them, when we're always adding new drugs, we'll alert you on it. So thanks for letting me do my little pitch, but go to costplusdrugs.com.
And again, thank you so much for joining us today. That was a great conversation.
Appreciate it, guys. I enjoyed it too. Thanks.
Hey, since Mark Cuban was allowed to do his pitch, apparently BT has informed me that my role has shifted from CFO, co-founder, and co-host to now being chief ad reader. Seems like a downgrade. Fine with it, I guess. I'll read the copy here. As chief ad reader, I'd like to say that we have 1 trillion subscribers on YouTube. Okay. Bennett is a data scientist, so I apologize. There's obviously not 1 trillion people in the world or that many people on YouTube, obviously. Let me continue. And we have 15 trillion subscribers across various podcasting platforms. Whatever. If you hit the like or subscribe button and leave a review, we promise to buy Cass a doghouse to sleep in. Okay. Cool. Well, hit like, subscribe, YouTube. I don't know. What?